Most SGX retail investors exiting at the STI peak are walking into a 1.5% fixed deposit trap, and the average cost of this liquidity tax is up to $2,500 per $100,000 locked away. Welcome to the pit. I'm Iggy, forensic investor ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. Now let's get into today's numbers. 100,000 Singapore dollars parked in a 1.5% fixed deposit isn't safety. It is a silent tax of $2,500 every single year. Most Singaporean retail investors are celebrating a green portfolio as the STI tests the 5,000 mark, but they are walking straight into a liquidity trap that destroys their purchasing power. Today, I am teaching you the exact 4-step framework to migrate your assets into a 4% sanctuary without letting the banks eat your spread. The Straits Times Index recently tested the 5,041 intraday high before pulling back. It is currently oscillating in the 4,950 to 4,970 range. For the first time in years, your portfolio is green and your gut is screaming to exit. But if you exit into a 1.5% bank deposit, you are mathematically guaranteeing the destruction of your wealth against my 3.2% forensic flaw. In traditional equity analysis, the health filter requires strict solvency checks before a single dollar is deployed. We demand a gearing ratio strictly below 35%. Think of it like your housing loan. If your HDB flat is worth $500,000 and your mortgage is $250,000, your gearing is 50%. We also require an interest coverage ratio, or ICR, above 4.0 times. Finally, we look for a net debt to EBITDA ratio below 5.0 times. You can find these in any SGX filing or Investing Pro. But here is the critical pivot. When you sell your stocks, your cash becomes your new active position. You must audit your cash vehicle with the same ruthless precision. Depositing cash into a retail bank is essentially lending money to an institution. The immediate problem you face in local currency is the parity trap. When you lock your capital in a promotional fixed deposit paying 1.5%, while standard rates at DBS, UOB, and OCBC hover even lower, you are funding their balance sheet, not yours. They take your money at 1.5 and lend it out at 5%. You are accepting the inflation risk while subsidizing their gearing. A 1.5% yield fails the 3.2% Iggy forensic flaw completely. It is not a sanctuary, it is a mathematical liability. For a 50-year-old Singaporean investor parking $100,000, this sub-inflation rate quietly erases thousands of dollars in real wealth. The bank is counting on your exhaustion. That is their entire retail deposit business model. My floor remains at 3.2% to ensure assets can withstand a return to long-term average interest rates. The minimum yield hurdle is 4.7%. If the yield doesn't clear that, it doesn't enter the portfolio. Finding the right cash sanctuary means understanding the forensic gap, the difference between the fair value of your capital's earning power and the retail yield you are being offered. Right now, Singapore dollar yields are heavily compressed. The 3-month compounded Singapore overnight rate average, SORA, sits at approximately 0.87 to 0.90%. Meanwhile, United States dollar institutional yields remain at a significant premium. This creates a currency yield arbitrage opportunity. Stepping out of your equities near the STI 5,000 level is exactly like stepping off a crowded North-South line train at Raffles Place during evening rush hour. You have made your move. Your portfolio is green, but standing frozen on the platform, which is what you do when you use a 1.5% fixed deposit, while the train pulls away, is useless if you cannot board the next one. You need to wait in the lounge. The lounge is a high-grade money market fund where you earn approximately 4.0% while waiting patiently for the next forensic entry signal. The local retail bank offers you 1.5% because they know you want safety after years of volatility. But accepting a poor yield for the comforting illusion of a local bank logo is a valuation error with a measurable dollar cost. An uncle holding his $100,000 in pure SGD cash is actively forfeiting the global yield premium. This directly cannibalizes his retirement timeline by accepting structurally inferior local rates. In the world of dividend investing, we spend a lot of time talking about the yield spread, the difference between what a stock pays you and the risk-free rate. But there is a hidden leak that most retail investors completely ignore: transaction friction. If you are deploying 10,000 Singapore dollars into a SG REIT and your broker eats a chunk of that in minimum commissions or platform fees, you are starting your investment in the red before the first dividend even lands. Data is only useful if you have the tools to act on it without getting eaten alive by those fees. That is why I use Longbridge. They are currently the only platform in Singapore offering lifetime $0 commission for US, HK, and SG stocks. Their data visualization is also some of the fastest I have used, which is critical when you are timing an entry in a volatile market. To help you plug that leak, I have partnered with Longbridge for a specific pilot program. For the first 10 readers who open and fund an account with a minimum of 10,000 Singapore dollars, they are offering a direct 100 Singapore dollar cash credit on top of their generous welcome rewards. Simply put, if you deposit $10,000, hold it for 3 months and complete 5 buy trades, you will receive an exclusive $100 cash coupon, $300 worth of Nvidia shares in total, as well as a 5% interest boost coupon valid for a whole year valued at $100 with a total value of $500. Why does this math matter to a forensic investor? Because $100 on a $10,000 deposit is an immediate 1.0% day one yield boost. It is the simplest way to neutralize transaction friction and protect your margin of safety before you even buy your first share. This is a one-time pilot, strictly limited to the first 10 spots. Link and full terms are in the description. Other fees and terms and conditions apply, so read those first. But for a forensic investor who cares about entry cost, this is worth 5 minutes of your time. Now back to the forensic framework, because understanding where your cash should be is only half the equation. When we analyze real estate, we hunt for organic NPI, rent driven by actual tenants, not sponsor top-ups. We watch out for engineered yields. For your cash, the equivalent is the liar's yield. This is an advertised rate that guarantees a loss of purchasing power once you account for inflation. The best bank rate is 1.5%. My floor is 3.2%. The gap between a 4% sanctuary and that bank deposit is up to 2.5%. This spread is your liquidity tax. When you park $100,000 in that traditional fixed deposit, you are effectively paying the bank up to $2,500 a year for the privilege of holding your money. This is a catastrophic failure of the income stress test. If a REIT payout ratio exceeds 100% of its free cash flow, it is a red flag. The same logic applies to your cash. If your yield cannot cover the 3.2% inflation floor, your purchasing power is structurally unsustainable. For a heartland saver, that $2,500 tax is nearly 3 months of basic grocery and utility expenses wiped out by sheer inertia. So what does this mean for you? The single step most retail investors skip is treating cash as an active position rather than a passive waiting room. They spend months auditing REITs, then dump their gains into a fixed deposit. The institution relies on your exhaustion to capture the spread. If your cash is not working as hard as your equity, you have not secured your profits. You have merely transferred them to someone else's balance sheet. To fully protect your capital, you must benchmark your cash vehicle against its peers. We are comparing that bank deposit against the iFast USD Enhanced Liquidity Fund A, accessed via the Longbridge Cash Plus platform. The retail bank fails the floor. The iFast fund clears it at approximately 4%. The reason is simple. The bank is a middleman extracting a spread, while the liquidity fund gives you direct access to institutional yields. Now we must address the currency reality. You are holding SGD, but the sanctuary yield is in USD. Right now, the SGD is operating from a position of strength. Converting to USD at this juncture means you are buying into the yield pool when your local currency holds peak purchasing power. However, this is not a short-term trade. It takes about 4 years of compounding to recover from a 10% SGD appreciation. This is a structural positioning decision for capital with a multi-year horizon. Longbridge provides the structural agility you need. Subscriptions process quickly and redemptions take about 1 business day. You hold that 4% sanctuary yield, and the moment the market presents a fortress balance sheet opportunity with gearing below 35% and ICR above 4 times, you can execute the withdrawal and deploy. You are no longer trapped behind bank penalty clauses. The core thesis is straightforward. The 6-month T-bill cutoff sits at 1.46%. The best bank deposit sits at 1.5%. Both fail the Iggy forensic flaw of 3.2%. They offer no mathematical protection. Meanwhile, the iFast USD fund generates approximately 4%. This spread of 250 basis points is the difference between subsidizing a bank and protecting your retirement. When you lock $100,000 into a 1.5% fixed deposit, your capital is frozen. You are paying a premium for the psychological illusion of safety. The traditional fixed deposit is marketed to your anxiety, but the math proves it is a wealth extraction tool. Smart money does not sit in retail deposits. Stop funding the bank's corporate expansion with your inflation-adjusted losses. First, audit your stagnant capital precisely. Review every account yielding below the 3.2% floor and quantify your exact dollar loss. Second, establish your migration pipe. Use a vehicle like Longbridge Cash Plus to ensure your cash earns institutional yields while remaining deployable. Third, time your conversion. Use the current market momentum to move into USD institutional funds while the SGD is strong. Are you going to let the institution buy a brand new corporate building with your interest spread? Or are you going to finally take control of your own sanctuary? If you want the tools I use to track these spreads and zero-day access to my personal portfolio moves, join Iggy's Elite Investors at the link in the description below. This video is a paid partnership with Longbridge Singapore. It is intended for general awareness and does not constitute investment advice or a recommendation to buy, sell, or otherwise engage with any investment products or financial services. The presenter is not a licensed financial advisor and is not offering financial advice. All views expressed are solely those of the presenter and do not necessarily reflect the view of Longbridge Singapore. All investments carry risks, may not be suitable for everyone, and you may lose your investment principal. Past performance is not indicative of future results. You should seek independent financial advice if you are unsure about any investment decisions. This advertisement has not been reviewed by the Monetary Authority of Singapore.